Thanks, Brian Mudd. This is my cheat sheet for Monday, April 9th. Okay, lots of economics here. I want to talk first about the stock market and real estate, where we're going next here. Now, you might recall at the beginning of January, I was suggesting that it looks like we're going to have a double-digit year in the stock market. Well, my predictions on these types of things do traditionally work out. Now, even I'll admit, we got there a lot quicker than I was expecting to. In fact, not only have we seen double-digit returns in all major indices from those traded on the New York Stock Exchange, the S&P 500, the Nasdaq's actually have 19% year-to-date. Here's the thing. We got a little ahead of ourselves. So we're overdue for a pullback, number one. And number two, well, here's the bigger concern. You know that what I've been talking about inflation, the real cost of inflation that's been running at 8.1% so far in 2012 over last year. That is simply not sustainable. Not when the average income growth is in the neighborhood of 2.5%. So something was going to have to give. And what you've seen is that something has started to give with a lot of larger companies. How many large companies have been naming layoffs here in the last 3 weeks? The latest overnight was Sony. Sony's now going to lay off 10,000 people. We're back into that cycle to where you hear some kind of major layoff, at least every couple of days. Not good news, right? No surprise, at least to me, was to most of the economists that we were going to begin to see that spill over into the labor market. That's why, among other reasons, you're going to see a horrible day in the stock market today. But 120,000 jobs being grown. What's really going on here is that as businesses are looking towards the future, they're seeing the economy slow down because of the real cost of inflation that's eating a hole in our pocketbook. So here's where I'm going to tie together a few different stories that I have this morning all into one pretty little package, and then you can go to the fiscal cheat sheet. Let's talk about gas real quick. Gas. How much are you paying for the Iranian sanctions? The National Foreign Trade Council is saying 25 cents per gallon. So yes, we're not sending missiles back and forth in Iran, which I'm happy for. But yes, our sanctions are actually costing us 25 cents a gallon. That's number one. Number two, we have seen a 14% increase since February 1st in the price we're paying for gas at the pump. Historically, between February 1st and the high we see in any given year is 27%. Meaning that we have another 13% more to go just to be on par with our average historical prices by the time we get into the summer and the summer blend of fuel. So what does that mean with gas prices at $3.97 a gallon nationally, which is where we sit this morning? That means that we hit a high price of gas sometime this summer of $4.49 per gallon. It's my crystal ball rubbing off. Actually, it's just putting all this economic information together. So as difficult as it is right now, stomaching near $4 a gallon gasoline, and in much of our area, it already is over $4 a gallon, imagine having to pay out another 50 cents more per gallon, because that's what we're going to have to do. All right, and that's assuming we don't have missiles going back and forth. Okay, and then I want to put this final package together. What is going on? Well, I've been saying for some time, at least the last 2 months, that you need to be considering real estate for free cash flow. I think that's the single best area that you can invest in. And by the way, even if you don't invest in, you don't want to buy like individual homes and properties, there's a way to position yourself with some equities in real estate as well. Consult your investment advisor. But you typically see a yin-yang between the real estate market and the stock market. There are periods of exceptions. That's when people are scared of everything. Read the Great Depression and the fall of 2008 when people ran to cash or to treasury bonds, right? But otherwise, you see a yin-yang. Let me explain real quick. Take a look at the period of time from the end of 1987 through the bull market run of 1991. You ended up seeing a period of time in which real estate net was down during that period of time, while the stock market was increasing by double digits on average each year during that period of time. And then what ended up happening? Well, real estate ended up bouncing back from a period of 92 to about 95 or so, at a time when the stock market was just kind of rambling along. But then what happened? We saw the dot-com boom come into effect in the mid-90s, and the stock market was off to the races all the way until March of 2000. Then, during that period of time, you saw real estate only averaging about a 1 or 2% return every year, but by the time that people got out of stocks in March 2000, that's what led to the real estate boom, because what happens is, as people pull their money out of stocks, they look for a place to put it. If there's a good alternative in real estate, that's people's second choice typically. So what's going to happen with stocks? You're going to see them, I think, begin to come down a little bit, and I think money will be moving into real estate. Cheat sheet for today. Enjoy yours. See you tomorrow.